Hey there. So I have a slightly different arrangement right now. I've got my little pen here, and what I can do is I can write all over this. So I wanted to write all over it so that I can mark out what's going on. And what we're going to do in here in Module 11 is we're going to go into forecasting financial statements. Basically, what forecasting financial statements involves is trying to predict what the financial statements are going to look a year, 2, 3, 4 years from now. And these are really important for financial statement analysis because ultimately the value of the stock comes from the future earnings of this company and not from the previous year's earnings. Because when you buy stock, what your returns are going to come from future profits. And previous profits are what we already know they are. So the excitement is trying to predict what's going to happen in the future. And the way it's going to work is that we're going to predict future earnings or future dividends, something that's going to happen in the future, and then take the present value of that to try to determine what the value of the stock is. Because in essence, the value of the stock is the present value of the future cash flows from the stock. So if you estimate the dividends from the company, the dividends of the company is likely to pay for the next 10 years, and you take the present value of that, you should, with a few adjustments, you should be able to get a pretty good estimate of what the value of the stock is. You can do something similar with earnings, and we're going to learn how to do that too. And we're going to learn to look at other ways to try to assess the value of a company. Ultimately, by understanding the value of the stock, we can compare, or by developing our estimate of the value of the stock, we can compare that estimate with what the actual value is, and that'll help us determine if the stock is a good investment. So if you go through a whole analysis and you determine that the stock is worth $120 and the actual stock is trading on the market for $90, that would tell you that the stock is probably a good investment. So there's a couple steps that we need to go through. But forecasts are really key for valuing stocks. You can't value a stock in detail without going through the process of forecasting future earnings and dividends. Forecasts will also help you to estimate a company's ability to repay its obligations and to evaluate alternative strategies and different things the companies are going to do. What you could do is, usually this is done internally, not externally, is estimate what's likely to happen in the future. And if, let's say you're trying to decide, should I release a new product or not? Should we buy this company? What's likely to happen in the future if we buy this company? And so forecasts help us to do this. And your goal is to estimate the future income statement, balance sheet, and statement of cash flows. And it's going to be done in that order. The first step is the revenue forecast. And this is the most difficult, and everything comes from your forecast of revenue. So what you need to do is you need to look very closely at what you expect to happen to future sales. And then from this, you're going to be able to estimate the full income statement, the balance sheet, the cash flow statement. Everything is going to come from the income statement as shown in the chart here below. Is really going to come from sales. And sales is your most basic piece of information. There's other information that's very important, but sales is the most fundamental foundation of the entire forecast. Now, there's two important things to keep in mind. The first is to assure internal consistency. Think about the different assumptions that you're making and how consistent they are. If you expect that gross profit, as it says here, gross profit margin is going to stay the same, then keep that in your forecast. And internal consistency is what's going to help you to identify all the problems and get the whole thing together. One thing that's very important also is that the financial statements articulate. What articulation means is that cash on the cash flow statement matches cash on the balance sheet. stockholders' equity, the change in retained earnings from the income statement flows into retained earnings, and that retained earnings flows into the balance sheet, and your balance sheet balances. So when we develop our forecast, we want to be extremely careful that everything works. This is a full set of working financial statements, and you can't cut any corners and say, well, my cash flow statement doesn't quite flow into my balance sheet, or the income statement doesn't flow into retained earnings. Everything has to work. This is a full set of financial statements. And usually when something doesn't work, that means that you have a problem that you need to figure out. But, and this is what really drives students crazy, especially other students, especially accounting students, is that everything relies on revenue, but a lot of other numbers are quite arbitrary. So getting everything to balance and be perfect is just not going to work with forecasts. So yeah, your balance sheet needs to balance, but sometimes you're not quite going to know if the difference would be in cash or in marketable securities. Cost of goods sold might be, you don't need perfect precision in order for your financial statements to be a valid forecast, because you're predicting the future and you don't really know what's going to happen. So it's meaningless to have a forecast where you have very high levels of precision 5 years into the future. That's just not going to happen. It doesn't work that way. So your level of precision is going to be very blurry. I don't know why I did that, but it's going to be blurry. And you just have to assume that not everything's going to be perfect. It does need to balance, and everything needs to articulate, but it's not going to be perfect. One thing which you may do is something called a sensitivity analysis. And this would be playing around with your assumptions to see what happens. And we're very interested in sensitivity analysis here. As we learned in the previous module, what would happen if you convert your operating leases to capital leases? What would happen if you booked more of your pension benefit obligation as a liability? How would these affect not only your current financial statements, but the forecasts? So what we want to do is, the most sensitive item is, of course, increase in revenues. What would happen if revenues didn't increase at 3%, if they increased at 2.5%? Would the company lose money? So we want to look very closely at what our assumptions are and see how big of an impact they have on our conclusions. So as you're doing your forecast, you want to think about what your assumptions are. And then if they're not so accurate, which assumptions are liable to not be accurate, then what's the effect of that uncertainty?